So good evening, everyone, and once again, welcome to our webinar this evening, where we're going to be talking to you about the local government pension scheme. So we're just going to give you an overview of the scheme to hopefully help you make some decisions and also know where you can get more information. I think that is also really important. It can feel a bit daunting, and it's good to have a guide or a steer as to where we go to find out certain details. So let's start with a little bit of an overview. The LGPS is what you sometimes see it referred to, and the LGPS stands for the Local Government Pension Scheme. Now, something that is really important here is that the Local Government Pension Scheme is like the overarching umbrella. So it's the overarching umbrella that tells you what the scheme rules are and how the scheme works. But underneath that umbrella, we've got different pension funds, and there are currently upwards of 80 different pension funds. So what that means is that the 60 of you on the session tonight will probably all be in different funds. Some of you might be in the Cheshire Pension Fund, some of you might be in Tyne and Wear, some of you might be in West Yorkshire. Okay, all of those funds are different. So they all follow the same scheme rules, and they're all part of that umbrella of the LGPS. But all of the funds will have their own website, they will have their own processes, they will have their own modelers. Okay, so one of the things that you notice is that in this session, I'm just going to refer to the central LGPS website, which also exists, and I've linked to that at the back. What I haven't done is link to all of the funds, because you will all be in different ones, and you will need to find out which one you are in if you are not sure. And that fund should then have its own website and its own portal and its own places for you to go to. So any questions tonight, if they are super specific to processes, I might not be able to answer them because the processes can be different across the funds, if that makes sense. So that's really important to know that. Any of you are part of Cheshire Pension Fund, then welcome, because we do actually run some seminars for Cheshire Pension Fund as well. So you might have heard me speak before. Now, the main purpose then of the LGPS, or the Local Government Pension Scheme, is to provide you with an income for when you stop work. So the pension benefits that you receive from a scheme like this is an annual income for life, like a salary. So if I retire at 60 and my pension at that point is £10,000, I will receive £10,000 per year every year that I'm alive. And in fact, it will be more than that because it increases each year in line with inflation. And that's its main purpose. It's to give you that fixed amount of regular income once you stop work. There are additional things as well that we benefit from being a member of the LGPS. So there are some what we would call ancillary benefits for your dependents, and we're going to talk about that a bit as we get further into the session as well. Pension savings is a super tax efficient way to save. I often get asked, should I save into a pension or an ISA? Again, can't really comment at this stage because that's financial advice. But what I can tell you is that all of the contributions that you pay into a pension, you will typically receive tax relief on, and therefore they're a really good tax efficient way to save. As we're also going to see later on, as we get a bit more into the session, you can then actually access some of those benefits tax-free as well. And whilst there are a series of rules that we need to follow that the LGPS sets in that umbrella that we talked about before, you do actually have quite a bit of choice about how and when to access your benefits. So again, linking back to something I said earlier, you'll all have different circumstances, and the way in which you choose to access your benefits, or how and when, will be different for each of you based on the circumstances. So there is a certain amount of flexibility in there as well. All of this will become a little bit clearer as we go through the session. One of the things, though, I would like to talk about is the state pension before we get into the LGPS. So your state pension is payable separately to the local government pension scheme. It's payable in addition to. So it's not part of your local government pension. It's a separate benefit that is available. What you can do when you get the slides, this little black box here is a link. And if you haven't done this already, what you can do is you can click on the link and it will take you to the relevant area of the .government gateway that enables you to get your state pension forecast. So what you can do is when you log in, it brings up a screen that looks a little bit like this. and it will show you what your state pension age is, and it will show you what your state pension entitlement is currently forecast to be. State pension age at the minute for most people now is 67 or 68. Some people it's still 66. For some of you, it might be 66 and 9 months, for example. It's not always your birthday, and you need to check that, therefore, and the forecast will tell you. Currently, for anybody born after 1978, such as myself, the state pension age is 68. So what that means is that you can't access your state pension until you reach state pension age. You can defer it if you want to, so you can take it later, but you cannot take it earlier. The current maximum amount of state pension somebody can typically receive is about £235 a week, which is £12,000 a year in today's money. The state pension currently increases every year in April, and it increases by something called the triple lock. Now, all the triple lock is the highest of one of three things, which is either 2.5%, the increase in earnings, or the increase in inflation. Now, that is massively valuable because since COVID, so since 2019, the state pension has actually increased by more than 30%. So it just shows you how significant that is. The amount of state pension that somebody receives is relative to your national insurance contributions or credits. Okay, so the current loose rule is that if you have the equivalent of 35 years at full rate national insurance credits, you should receive the full state pension entitlement. If you do not have that, then you will still receive a state pension, but it will be less. And this is why it's important to check your forecast so that you can include that as part of your overall pension planning. The other thing to remember is if you're thinking about retiring early, your forecast might be showing you your estimated state pension, assuming you continue to work and pay national insurance to state pension age. If you pack in work at 55, excellent. But that does mean you will stop paying national insurance contributions at that point. And so it's always worth checking again if you will have the full state pension entitlement at that point in time, or if not, it's less. And is that okay? Because again, you need to factor that into your planning. Okay. So it's just handy, I think, to give everybody a quick state pension update before we get into the LGPS, because ultimately it can be quite a big part of the pension planning. So before I move on, does anyone have any questions about the state pension? I just have this small question break because it means I can have a drink of tea. I'll just hang on a second just to see if any pop into the box. Hopefully everybody can see the slides now. Okay, nothing on state pension. Perfect. Right, let's move on. Let's talk about the local government pension scheme. Now, one of the things that we need to understand about the local government pension scheme is that there are three sections to the scheme. Okay, and you can see we've set them out in these grey boxes here. Just ignore the one on the end for the moment. So we've got a section that runs up to the 31st of March 2008. We've got a section that then runs from the 1st of April 2008 to the 31st of March 2014. And then we've got a section that came in April 14. Okay. And that is our main structure of the local government pension scheme. So the section or sections that you are in will depend on when you joined. If you joined before the 1st of April 2008, you will have some pension in the first section. Anything then from 2008 up to 2014 is in the second section, and anything from after 2014 is in the third section. Usually, again, it can vary. When you get your annual benefit statement, you can see a split across your benefits. Now, sometimes what the schemes do is they put these two sections together and call them the final salary sections. And then they will show this one separately, which is sometimes called the career average or the care section. Okay, so you might see them split out on your statement, but your total pension entitlement is everything added together. The local government pension scheme is what we call a defined benefit pension, and this is because the pension benefits that you receive are based on a formula. And that formula then calculates your income that you have for life. Okay, so for that reason, the benefits are predetermined or predefined because the formula tells us how we calculate the pension benefits. So let's have a look at this in a bit more detail. We've put the formulas here for you on the slide. Now, if you're not very mathematically minded, don't worry about it. The scheme does these calculations for you, but it's just to give you an idea of how it works. What we do is we look at your service. Okay, so for the two first sections before 2014, we look at your service. Now, your service is the length of time in that particular section for, pro rata if you ever was part-time. Okay, so we would take your service in years and days, we would divide it by 80 for this first section, and then we times it by your pensionable pay. Now, your pensionable pay is usually the pay in the last 12 months before retirement or leaving, and it is the full-time equivalent pay. So even if you work part-time, we use the full-time equivalent pay. And that then gives us your annual pension income. So as we said earlier, if that was £10,000, then I would receive £10,000 per year from a retirement from that section. Now, this earlier section as well also has a lump sum that's payable in addition to the pension. And the lump sum is 3 times whatever this pension amount is. So if my pension amount is £10,000, 3 times that would be 30,000, and that would be the lump sum. Okay, so that's part 1. If you're then in part 2, which is anything between 2008 and 2014, it's very similar. So it's our service, again, pro rata for any part-time working, but divided by 60. So the most service we can have in this section is usually 6 years, which is 2008 to 2014. Because in 2014, it then changed again. So it could be 6 years, it could be less if you work part-time, because again, it's pro rata. But it's our service in years and days divided by 60 this time, times by, again, the pensionable pay. And again, this is usually the pay in the last 12 months, but the full-time equivalent pay. And that again will give us a pension per annum. So that might be £5,000 per year, for example, for that section. So that is payable in addition to what we've calculated in the first section. Now, this section doesn't have an automatic lump sum, so you just get the pension, but you can choose to swap some pension for lump sum later, and I'm going to talk to you about that a bit later on. And then from the 1st of April 2014, another change came, so we were all moved again for all pension from 2014 into the care section or to the career average pension. Now, again, this is still defined benefit because we have a formula that calculates the pension, but you can see it's a bit different this time. We will take 1 and divide it by 49 this time and times it by your actual pensionable pay each year that you're in the scheme. So let's keep it simple. Let's say that my pay was 49,000. I'm going to divide that by the 49. And that gives me £1,000 per annum of pension for 1 year in the career average scheme. The next year, we're going to do the same thing again. So we're going to take my pensionable pay. Let's say it's gone up to £50,000 a year. So we're going to take the 50,000 and divide it by 49. and that gives me pension of 1,020. I add that on to the £1,000 that I've already got, and I've now got £2,020 per annum of pension from this section. And the following year we do the same thing again, and so on. So it builds like that each year based on your pay each year, and it just grows and grows and grows like that. And again, this is payable in addition to these earlier two sections. There is also no automatic lump sum for this particular section of the pension, but again, we can swap some pension income for a lump sum, and we're going to talk about that a bit later. Now, the statements that you receive, as I say, will do these calculations for you, and most of them will show the pension that you have built up to the 31st of March, and they're probably being updated at the moment for pension to 31st of March 2025. Okay. Some of you, if your scheme is quite good, your statement might actually also project forwards and show you an estimate of what your pension might look like at pension age. So pension age is the age at which you can take the pension benefits in full without any reduction for early payment. And you can see that it is 65 typically for the two earlier sections and state pension age for the newer section. There are some circumstances where the first section could have pension taken from age 60 without any reductions. That's typically something called the rule of 85, and I'm going to talk to you about that a bit later as well, because some of you probably know a bit of something about that. Now, these pension ages are not the mandatory ages. They're not the ages that you have to take the pension from. They're the normal ages for each of the schemes. You can choose to take your pensions earlier if you wish. And you can see at the moment that is from as early as age 55. If you do that, the pension is reduced for early payment, because what we're essentially saying is that we want the pension paid to us for more years. And so they're going to reduce it down so that on an average basis, you actually receive the same amount of money overall. So when you should retire is one of your considerations, and hopefully your pension fund has a calculator that you can use online so that you can play around with that and say, well, what do the figures look like at 57? What do they look like at 60? What do they look like at 62? And so on. So that becomes part of the planning. So don't obsess too much about the age specifically, but look at the numbers and what works for you. But this is how your pension is calculated. So it's linked to your pensionable pay and it's linked to your past service for these two earlier sections. So I'm just going to pause there because that's quite a lot. And just to see if anybody's got any questions at this point about the basics of how the pension is calculated or what you might need to think about. Great question. Is there a local government pension calculator to use, as my pension fund doesn't have an online calculator? Of course it doesn't. Most do, not all of them do. Let me have a look. They used to be, and then sometimes they take it down, and I have a feeling they don't have it on here at the moment. I think they just have early retirement factors. Yeah, so at the moment there's no calculator, but I have put a link in the slides to the local government pension scheme central website, and on there you can find what the early retirement factors are, so that you can see what sort of reduction you would have if you took the pension benefits earlier. Your pension fund as well should have a mechanism for you to be able to request a pension estimate or a forecast if you don't have a modelling tool, so have a look at that as well. Is the lump sum pre-2008 mandatory? Yes, you can't get away from that. You don't have to increase it. You can choose to increase it, but actually, yes, it is mandatory now. It didn't used to be, but it is now. You have to take that. Can get estimates, but it's for specific single dates. Yeah, unfortunately, if that's what the fund's got at the moment, that's what you will have to work with, I'm afraid. I'm currently on protected pay. This ends November. I want to retire August 26. What figure will they take? Really good question. So you will obviously have been paying attention and notice that what I said is typically it's the pay in the last 12 months. What they do, or they can do if you request it, is they can look back at the previous 3 years' pay to see if there is one that was higher. So if your protected pay ends in November 25, then from August 25 to August 26, then you will have lost some of that protection. But what they can do is go back and look at August 24 to August 25, if that will then provide you with a higher pay. You need to make sure they do that. They should do it automatically. They don't always. So do make sure you inquire about that. Do all LGPS schemes apply reductions in the same way? Yes, they do, because that umbrella that we talked about of the LGPS scheme, that sets the factors for early retirement and how and when you take the benefits. So all of the pension funds will have the same reductions, and that is why they are on the central LGPS website. Can you take sections as you become eligible for them, e.g. when you hit the 85-year-old, or do you have to take them together? Good question, and we'll come back to this a bit more when we look at retirement options, but the basic rule is you've got to take them all at the same time. Now, there is a way round it in that you can do something called a flexible or a partial retirement, which means working a bit less and taking some of the pension. And if you do that, then it could, for example, mean you could access this earlier bit under the rule of 85 and leave the rest of it till later. So, but you have to do a flexible or a partial retirement to do that. If you leave or you retire completely, you have to take them all together. I'm going to talk about 85-year rule a bit later on. When you change council, should you amalgamate the pensions or keep them separate? No one size fits all answer to that, I'm afraid. You will have the option to amalgamate or keep them separate. Things you need to think about is, has your pay increased? Because remember, these two sections are based on current pay. So if your pay's gone down, then it means by amalgamating the pay, the pension could go down. But also you want to think about long term. So maybe it's gone down now, but in 5 years it will have gone up quite a lot, depending on promotion prospects. Also think about how you want to access them. As we've just said, you've got to access all of the sections together, usually. But if you keep them separate, then they're separate pensions and you can access them separately. So if you're looking at making a decision like that, you might need to get some extra support tailored to your circumstances about what could be the best outcome for you. Can you take your pension after the NPA and would the money be backdated? You can take it after the NPA and no, it is not backdated unless you're deferred. So if you're in active service, they still keep a link to your current pay, so you're still building pension benefits and so they would not be backdated. If you are deferred, that means you have left the scheme and you are no longer paying into it. If you then access the some of it after the normal pension age, they might backdate some of it. But again, it's unlikely because you've got different normal pension ages for each of the sections. And of course, you have to take them all together. I'm going to come back to Rule of 85, hold off on those questions, and I'll get there when I get to the retirement section. Okay. Any other questions there before I move on to something called the McCloud Ruling? You cannot access anything from these schemes at 50 now. As the slide says here, the earliest minimum pension age that you can access benefits from is 55. Again, so we've got a question here about after 2014, if wages increase via job changes, is it best to amalgamate if you're only 45? Can't tell you specifically. It's all about the circumstances, and that would need to be looked at with a proper conversation about your objectives and things like that. I know you want me to tell you the answer, but the reality is the answer for you would be different to the answer for somebody else. So it's all about kind of looking at those personal circumstances and what's been going on. Coming on to the AVC later. You're all really bad, aren't you? For those of you who missed it at the start, I said, can we keep the questions to the section that we're talking about? And none of us have managed to do that, but never mind. Can you still pay into the LGPS pension if you take the 85 and flexible retire? Yes, you can. And we're going to talk about that as well. Okay. Anybody heard of the McCloud ruling? If you can use your reactions at the top of the screen. Ooh. Oh, hurrah! Thank you. A couple of people have. Okay. It's a non-event really for local gov. If you're on the Facebook group, you'll see that we talk about it a lot for all of the other public sector schemes, so NHS, civil service, teachers, and so on. For local gov, it isn't so big an issue, and that might be why I haven't really heard of it. There will be some information on your pension fund website if you go on there and have a look. But there's not really a great deal to this, as you might think. And the reason for that is because the LGPS did something different to the other public sector schemes, and that's why it's kind of a little bit of a not quite as a big a deal, if you like. So you'll be aware from what we discussed earlier that there was a new section that was brought in on the 1st of April 2014, and we know that as the care section or the career average section. When that was brought in, as with all of the other changes that happened in the LGPS, everybody was picked up and moved into that section for new pension going forwards from 2014. Okay, so that happened right across the board for everyone. However, there was a little bit of an underpin or a protection that was put in place for those people who were a bit older. So if you had less than 10 years to your normal pension age, effective from April 2012, then when you came to take your benefits, they were calculated on the new basis from 2014 onwards, but also they were calculated on the old basis, so before the 2014 changes, if you carried on in the other section. Okay, so they did both calculations and then the scheme paid out whichever was the highest. Okay. But if you were somebody who had more than 10 years to a normal pension age, you didn't get that either or. You just got your pension calculated on the new basis only from 2014 onwards. Okay, that is age discrimination, and that was impacted by the McCloud ruling. Okay, so you can see it here. So before, if you had less than 10 years, then this period between 2014 and 2022, both calculations were done, and then whichever was the highest would be paid. But for more than 10 years, you didn't have that kind of secondary check. Okay, can't do that. Age discrimination. So the McCloud ruling was designed to remove any age discrimination. So the way that the local government pension schemes are doing this is that essentially for the period from April 14 to April 22, everybody has both calculations done for them. So basically, they'll calculate pension from April 14 to April 22 on the new career average basis. They will also calculate the same period on the old final salary basis, and you will be paid automatically whichever is the highest. There is no decision for you to make. The scheme will just go this one or this one, and they'll say this one is higher, and that's what you will get. Okay. And then from 2022, everything is just on the new career average basis. Okay. May surprise you to know that there is very little difference between the two options. Okay, doesn't matter what your retirement age is, very, very insignificant difference. So you plan for what you can see now. You plan for what's on your statement, and you will either be on the right ballpark or it might be very slightly higher. It's definitely not going to be lower, is it? So don't worry about it too much. But if you see or hear McCloud, go onto your pension fund website, read a little bit more about it. But to be honest, it is not significant to your pension benefit. Okay. Any questions on McCloud? Okay. One thing that you can also do so let's say you have a pension fund that gives you a little calculator that you can use, and you go on there after this session and you go, oh, I'm going to look at what my pension will be at 58. And then you go, oh, sad, that's not enough. You do have options to pay extra pension contributions. And you've got some within the scheme and you've got some outside of the scheme. And so I'm just going to talk briefly about what they are, and that's also going to answer a couple of the questions that we have in the chat box currently. So your main options are something called an AVC, or an additional voluntary contribution, something called an APC, or additional pension contribution, or you also have personal pension or private pension arrangements. Remember that any contributions that you pay into a pension scheme will typically attract tax relief up to 100% of your income. There are some other limits on how much you can pay into a pension. I won't get into that now, but if you're a very high earner, that might be something that you want to have a look at before you start making any decisions to pay anything extra. Now, your AVC is a defined contribution scheme. So you might remember that I mentioned earlier, your local government pension scheme is what we call defined benefit, because it means that we have a formula that calculates our pension for us. In the UK, we have two types of pension scheme. We have defined benefit, or DB, and we have defined contribution, or DC, and they are very different things. Quite often people try and compare them. It upsets me greatly because they are not the same. They do different things, okay? An AVC, or an additional voluntary contribution, a personal pension, a stakeholder, most private sector pensions, or a SIP, if you've ever heard of a SIP, which is a self-invested pension plan, very popular at the moment, are all defined contribution schemes. And what that means is that the pension contributions that you pay are invested in a fund or a pot. Okay, and the value of that can rise and it can also fall depending on what's happening in the investment market. Long term, you expect it to overall be worth more, but it might fluctuate and peak and trough along the way. So I have one of these types of pensions, and as soon as there's a big political change in the world, it drops and then it kind of comes back up again. Okay, so when we have a general election, it generally goes down and then it might come back up again because there's a degree of economic uncertainty. So if you watch it every day, don't do that. But if you do, you'll see it fluctuates all of the time. There is no guarantee with these pensions, though. So with your local government scheme, what we're saying is that formula based on your service and your pay, that's going to give you a set amount of income and you're going to receive that forever and a day. You don't have that with these because it's got that investment where it can fluctuate. So if you happen to take the pension money at the wrong time, so for example, what happened in 2008 was we had the big recession, the bottom dropped out of the market, the four horsemen of the apocalypse rode in and all that kind of stuff, then the value of your pot could have been quite a lot lower than it was before that happened. So you have to allow for those things and look at where you're invested. Is it high risk or is it low risk and things like that? The advantages of them, though, are that you can choose how much you pay in. So your contributions are really flexible. You can start, you can stop, you can pay more, you can pay less. You can also access these pensions currently from 55. If you joined before 2021, that might be rising to 57 from April 2028. It depends on the scheme rules. You've then got a pot of money, okay? So when you retire, you can use that pot of money to buy a pension. You can take up to 25% of it potentially as a tax-free lump sum. You can do something called drawdown, and that means you can just pull it out as cash in chunks, but you will pay some tax on that potentially, be it tax assessed, okay? You've got lots of flexibility within it. You can access it totally separate to your local government main pension if you want to. However, if you decide to do an AVC through the local government pension scheme, then you may be able to access the entire fund as a tax-free lump sum if you take the benefits at the same time as your main local government pension. There will be a check the scheme has to do because there is an overall maximum amount of cash somebody can have tax-free, but assuming it's within that limit, then the potential is that you can take the whole of your AVC as a tax-free lump sum, and that is incredibly tax efficient. If you go to a personal pension or a SIP or one outside of the LGPS, you cannot do that. You can only take a maximum of 25% tax-free, subject to an overall limit. So that is something to bear in mind. So somebody said, is there a special tax advantage to an LGPS AVC? That is definitely one of them, is that if you think you want to access it at the same time as your main LGPS benefits, you can potentially take it all as a tax-free lump sum, which I think has also answered one of the other questions in there. As I said, there are overall limits. You will need to get some help with this. You will need to check your overall position so that you can do what you want. So the maximum, so it's quite complicated. There's two limits, okay? The first limit is that HMRC say that overall you cannot have more than 25% of the value of your pension benefits as a lump sum tax-free. Now, for schemes like this, it's very easy, because if my pot is worth £100,000, 25% of that is £25,000. So I know I can have that as a tax-free amount from that pot. But my LGPS benefits need to be factored into that as well. And that is a different calculation. That essentially is something called the capital value. And that is the pension times 20 plus any lump sum, 25% of that. So you can see it's a bit more complicated when we start factoring that in. And that's why you need to make sure you get the right help to determine the maximum that you can have. There is a further cap, which says HMRC say that you can't take lump sums if they exceed 268,275. If they exceed a total across all of your pensions of 268,275, then you will pay tax on anything over that amount. So again, just something to check there. So somebody says, if my AVC is £40,000, is this still tax-free? I don't know enough about the circumstances to be able to tell you if it's within that amount. I would assume probably, but I don't know, because we need to look at your specific circumstances. Okay. So it is flexible. It's an incredibly tax efficient way of saving. Just be aware of fluctuations. Now, again, each of the pension funds have different people that they use for their AVC. Most use Prudential or Standard Life. Some use both. You would need to make sure that you check with your pension fund what the process is and who the provider is, so that you can get that set up. If you pay your AVC contributions regularly through your payroll deductions, you will also get the tax relief at that point in time, so you don't need to do anything further about that. Okay, that is defined contribution schemes. So that is your AVC, personal and private pensions as well. They are good because they are flexible. They just don't provide you with that regular income. So it depends on what is important to you. The other thing about these funds is that if you die, the whole fund can be paid to whoever is your nominated beneficiary, assuming you haven't taken any of the benefits. And that also can be an important factor depending on your personal circumstances. That can also be a consideration. The other option we have got is the additional pension option. So the additional pension option is very much what it sounds like. What it means is that you can pay additional contributions into the LGPS, and it will increase your annual income from your LGPS benefits. So I'm just making up these numbers just to give you an illustration, okay? Let's say I pay in an extra £100 a month every month between now and when I retire. That might mean that instead of my LGPS pension being £10,000 a year, it would be £11,000 a year. So what I'm effectively doing is paying extra contributions to increase my annual pension income. Okay. You can choose as well to have some of that income be available for your dependents in the event of your death. You can choose to do monthly contributions for a period of time. You can do one-off lump sum contributions. If you go onto the LGPS website, again, the link is in the back of the slides. There is a calculator online that you can use to play around with that to see how much you would pay versus what benefits you would get. And again, remember, you get tax relief on those contributions as well. It is possible to pay into an AVC and an APC at the same time. Yes, just remember those overall limits that we talked about. If you want to benefit from the tax relief, so you need to be careful in case you pay in too much. It's unusual, but if you did one big lump sum payment in a year, for example, or you're a high earner, that might cause you some issues. So just be aware of that. What about NI payments if you increase your AVC? Do they change? No. And yes. So if you just pay your AVC contributions through payroll as normal, it has no impact on the NI contributions. Some of the pension funds and the employers, however, offer something called a salary sacrifice. And what that means is that you effectively pay extra contributions by giving up some of your pay. And by doing that, it means you will pay less national insurance contributions, and that can also be invested into the pension fund. It doesn't affect anything else. It's just a benefit that employers can use as part of this. Again, it's fund specific. So you need to check with your fund if they do it through a salary sacrifice and if that is something that will be of benefit to you. Are additional pensions subject to early access as well for early retirement? Yes, absolutely. So your additional pension contributions are linked to your main LGPS benefits. So if it's saying I'm going to buy £1,000 worth of pension, that will assume that I take it at my normal pension age of state pension age. I can access my pension earlier if I wish, but it would be reduced because it's being paid earlier, like the main benefits would be. It has no, so we've got a question of if we do the salary sacrifice, does that impact the state pension as paying less national insurance? No, because your state pension isn't about the amount of national insurance contributions you've paid. Because think about it, if that was the case, part-time people would have less state pension than full-time people or higher paid people. So long as you're earning above the minimum national insurance threshold, and they're not allowed to let you drop below that because that also means you're below minimum wage and you can't do that either, then actually you're fine and it doesn't affect any of your state pension benefits either. Okay, we all right? Loving the questions, everyone. Thank you. Keeps me on my toes. So when and how should you put your pension benefit into payment? So this is very unique, as we said before. There's no one size fits all. I think sometimes people want to come on these sessions and they want me to tell you what to do. And I cannot possibly do that because I do not know enough about you or your circumstances. But things you might want to consider are how much lump sum do you want? So I'll come back to all of these in a minute. Your overall finances, income tax, the age at which you take your pension benefits, and also the schemes or the sections that you are in. Now, your overall finances, I'm going to start there, really important. This is something called Know Your Number, right? So we will talk about it a lot as Know Your Number. The amount of people that I will be helping with individual planning, and they will say, when can I retire? And I'll go, okay, how much money do you need? Well, I don't know. Okay, how much money are you going to get? I don't know. Okay, that makes it quite hard to know when we can retire. So you need to know your number, and what your number is the net amount of monthly income that you need to live off. And that might be the same as what it is now. It probably isn't, because when we get to retirement, we've usually paid off some stuff. We've got rid of the kids. There's no mortgage anymore. We might not need to run 2 cars, all that kind of stuff. So you need to look at your finances now, but also what the finances will look like at the time when you take the pension benefits. Okay. Your pension isn't going to match your salary. We just need to get over that, but it shouldn't need to, because you've got things like state pension, and also, as I say, you're saving on certain expenditure. Also, we don't have national insurance deducted from our pensions, as we talked about before, so the deductions that come off are less, which is why the net numbers are important. Okay. We've also got to remember that the pension itself is subject to income tax assessment. So lump sums are tax-free up to those amounts we talked about before, but your pension income is classed as income by HMRC. So you may pay income tax on that. All of the figures that you're going to see on the modelers or the portals or your statements are the gross annual income figures. The pension scheme can't provide you with the net figures because it doesn't know all of your taxable circumstances. There are lots of online calculators you can use. One of them is my favorite, is Net Salary Calculator. And you can use that, and that will help you to work out what the net income will be after tax and so on. So do have a look at those, because they are really helpful, and that can also help you with your planning. The age that you want to retire, as we've said, that has a big impact on this. So when do you want to retire? As we've talked about, at the moment, the earliest you can retire is 55, but the pension will be reduced for early payment. The normal pension age for the 2014 or the career average section is state pension age. I've put that at 67. As we discussed, it's going to vary depending on when you were born. Now, at the moment, if you are female from age 60, your average life expectancy is to age 89. And if you're a male, it's to 86. So it's quite a long time, isn't it? And that's what we've got to plan for, which is why the regular income from the LGPS that's paid for life is really valuable here, because when you look at it like that. Also, if you're a female, you've got about a 6% chance of reaching 100, and for a male at the moment, it's 3.3%. By the time my daughter's generation gets there, it's going to be about 15 to 20% if things carry on as they are. So that's quite an eye-opener, isn't it? So you've got options about your pension, and we've talked a little bit about some of these already, but I think we need to go back through them because it's going to cover some of the questions. Okay. So normal retirement, that's when we take our pension benefits at the normal pension age. So there's no reduction for early payment. Early, sometimes referred to as voluntary, is when you take the pension benefits earlier. Currently, that's any time from 55, but they are reduced for early payment. So the rule of 85, anybody heard of the rule of 85 before? Hurrah, of course you have. Everybody hangs on for the rule of 85. So the rule of 85 is still a thing, but there are some big buts around it, okay? The first thing is the rule of 85 only affects the first section. So I'm just going to jump back to my earlier slide. It only affects the pension up to 2008. Doesn't affect anything beyond that. And that's one thing we need to bear in mind, okay? So what the rule of 85 says is if we take your total service, so your whole service in the scheme, plus your age, is it more than 85? If it is, and you are 60 or more, you can access the first part of the pension, so this bit here, unreduced from age 60. And there is nothing that can stop you from doing that, except that you also need to take the other two sections as well. Their normal pension ages are 65 and the state pension age, so they would be reduced for early payment. The exception is if you do a flexible retirement. So, for example, we get to 60 and we meet the rule of 85. We want to reduce our working hours. We want to drop to 3 days a week. Our employer says yes, because they need to approve that. That enables you to then access some of the pension, but continue working and building up more pension. That's called a flexible retirement. So in that example, we see it quite a bit. You could go at 60, take the earlier bit unreduced, so you're not missing out on that, work less, carry on building up more pension. It's quite a nice place to be. But your employer has to agree, because you need to reduce your hours. And of course, you have every right to request flexible working. They have every right to refuse it. So you can't assume you can do it. Now, one of the other questions we had is, can you do it if you're under 60? In theory, the rule of 85 does still exist for anybody who is between the age of 55 and 60. However, between the ages of 55 and 60, there is something called the pension strain, which means there is a cost to the employer for you to take your benefits unreduced from 55. And so therefore, the employer has to agree to pay the costs. Now, let me just say here, no employer is agreeing to that. So we will generally talk about the rule of 85 applying from 60, because at that point, there is no cost for the employer. But before 60, there is. And of course, then they'll say no, won't they? Because why would they say yes? So really, we're looking at from age 60 onwards. Okay. So you need to be having a look at that to see if that is something that might apply to you. Do the online calculators have rule of 85 built in? Some do, some do not. If you are not sure, what I would do is contact your pension fund and ask them for an estimate, mentioning very specifically that you will be covered by the rule of 85, so that you know it is included in the estimate. You can also read the notes. A lot of the modelers should have notes on them about what it does and doesn't include, so you can have a look on there to see if that might give it away for you as well. Is it all service or service in the pre-2008? So when we're doing service plus age, it's all service, okay? But when we then do which bit of the pension you can take unreduced, that is the pre-2008 service. How far in advance can you ask for this? Again, it depends on the pension fund. I feel like I'm not being very helpful here, but it's just there are 80 funds, they've got different rules. Some will let you ask whenever, particularly those who don't have a portal. Some might have a restriction, it's got to be 12 or 18 months before the intended pension date. So again, you'll just need to check. What you can do, of course, though, is ask the fund if the modeler takes account of the rule of 85. If they're not going to give you an estimate, you can ask them that. Okay, does that make sense? So, I mean, the thing that I always say to people about the retirement option is look at when you want to go and how you want to go. Because very often now people want to phase out. They don't just want to work and stop, or they might want to work and stop what they're currently doing, but they might want to go and do something else. So you might have sources of income coming at different times. You might have part of your LGPS, you might have all of your LGPS, you might have a private pension, you might carry on working a bit until state pension age. So when you're doing your plan, you've got to try and take account of all of these different things because it's not all going to come to you at once, typically. So one of the other options you have is lump sum versus pension. So as we said before, you can choose to swap some annual income for a higher lump sum. Okay. Now, where you are doing this from your LGPS, the rate at which we swap pension for lump sum is 12-1. So we calculate the maximum lump sum you can have, and then we would swap out pension for lump sum using a factor of 12-1. So if I could have another £12,000 of lump sum, for example, that would take £1,000 per annum off my annual pension. It's not a great factor, and that is something that you will have to consider. Okay, and again, there's no right or wrong here. If you've got an AVC, we could calculate the maximum lump sum. You might not need to take any off your pension because you can take it all from your AVC. And again, as we said before, that's what you need to be looking at. But some things to think about. How much do I need as a regular income? So if I need £10,000 a year, because that's what's going to meet all of my costs, and by taking a higher lump sum, my income goes down to £7,000 a year, that might cause me a problem. So I need to kind of think about that. What am I going to do with the cash? So you might pay off a mortgage, which means your regular income requirements will reduce because you don't have that mortgage payment. You might want to invest it. You might want to set up a little side hustle, all of those things. So what you're going to do with it will also determine what that then looks like longer term. When does other income start? So might be what some people do. Again, not advice, but just as a suggestion. Some people take a slightly higher lump sum. They use that to supplement their annual pension until their state pension kicks in. And then when the state pension kicks in, they've got that extra income. We also do more earlier in retirement. So we want to spend more when we're a bit younger, whereas when we're a bit older, we don't need quite as much money and the state pension's kicking in anyway. So sometimes it's about value for money by thinking about this. Sometimes it's about what actually do I want to do and make it work that way. So again, it depends on what you think that looks like. How long are you going to live for? Because this is telling us really if we live for more than 12 years, maybe we'd be better off taking the higher pension, but the pension's taxed, lump sum isn't, pension increases each year, lump sum might not, depending what I do with it. So maybe it's more like 15 years, I don't know. And they're kind of things that you've got to work through. What happens when you die? So your pension, we're going to come on to this, can be left to dependents, not your pension, a percentage of your pension. Some people like to take a higher lump sum so that you can leave that to dependents. So again, it's just a case of working it out. And also inflation is important because the pension increases each year. It's in payment by inflation, whereas the lump sum, again, is only paid to you once. So it depends on what you are going to do with it. So again, no one size fits all. Some people are very clear about this, some people are not, and it's just a case of weighing up the circumstances and what would work best for you. And again, factoring in any other income that you might have in the household, so whether that's work, state pension, private pensions, partner's pension, and so on, so you can work out what the best option looks like. Any questions on lump sums? No? Okay. So we're coming to the end. So we've done very well for time. I know there's a couple of questions I haven't answered, so I'm going to come back to those, but I just want to get through these next couple of slides. So you might remember I said right at the start of the session that the scheme also provides what we call ancillary benefits. So the main purpose of the scheme is to provide you with that regular income, but it also provides benefits in the event of your death. So whilst you are in service, and that means an actively contributing member of the scheme, there is a lump sum payable of 3 times your pay. And that is left to whoever you have nominated to receive that. So that can be a spouse, a partner, child, children, charity, pet. Yes, pet. Multiple people, multiple beneficiaries. You need to make sure that you have filled in your nomination form. Again, each of the funds has a separate form, so you need to go onto the website and find that. For those of you who have a portal, you might find you can update it on the portal. You can change your nominee as many times as you like. So if your personal circumstances change, you separate, for example, remember to do your form. It's really, really important. There are also spouse and partner pensions and dependent child pensions. They are spousal partner pension is somewhere between 30 and 50% of yours. It just depends on which section you have been in and for how long. Again, you can find more online about the scheme for the scheme guides. Again, they are payable for the life of the spouse or the partner. There are dependent children's pensions payable to children who are under the age of 18, under the age of 23 and in full-time education, or who are unable to work due to physical or mental disability. The exact percentage depends on whether there's a spouse or partner's pension. So again, be worth looking at that. And if you are separated but not divorced, you might want to bear in mind that legally they would still be entitled to a pension in the event of your death. Okay, so it's really generous. It provides all of this cover. You need to just make sure that you understand it. The scheme also does provide ill health benefits, and what that means is if you are too ill to work due to a permanent illness or injury, then you might be able to claim your pension early without any reductions, and in some cases it is also enhanced or uplifted to be what it would have been had you been able to stay at work, which is also incredibly generous as well. So there are a lot of benefits from being in the scheme. So before I do the last bit of the questions, I'm just going to suggest some actions for you. So have a look at your portal. If you've got one, if you haven't registered, it might be worth registering. Check your details. So if you don't have a portal, but you get an annual statement, check your annual statement, because the pension scheme receives information about you from your employer, and that's what they use to calculate your pension. So if your service is wrong, if your pay is wrong, then your pension will be wrong. So it's really important that you make sure you check your details as well. Consider whether you want to do any additional contributions. Make sure your nomination forms are up to date, and if you can and you have them, use your modelers, and that should help you to create your wider plan. The more research you do on this, the easier it becomes. I often say to people, it's an iterative process. We shouldn't be trying to plan our entire retirement and pension options in the space of 3 months. You need to walk into this, don't run. So the more that you do, the easier it becomes. Might feel a little bit overwhelming at the moment because you need to just go away and kind of chunk it down and look at different things. And look at it, walk away from it, go back and look at it again. These are very significant financial decisions, and so it's important that we take the time over them that we need to. Use all of your free resources. So the LGPS website is there. Check your own pension fund portal as well. The free resources are really good. Sometimes they're not enough. Numbers and planning like this is not in everybody's wheelhouse. We know that. Where you are struggling, it may be worth looking at getting some additional help or support. We usually will put a lot of time and research into a major purchase. We might even pay for expert advice on that purchase, such as if we buy a house, we will get a survey and we will pay for it. If we buy a car, we will do loads of research and things like that. Your pension is your biggest financial asset. And if it isn't, it's only going to come behind your house. So if you need to pay for support to make sure that you get good, robust decisions, then do that. Don't be put off by it, because it's going to be much better for you in the long run. But I would say again, use all of the free stuff that's available to you first, because it is there to help you. But know that there are other places you can go if you need to, such as our Facebook group and so on. Okay, I'm coming to questions now. So I'm going to go back and go look at anything that I missed. And if you've got any more questions, then hoy them in the box and let's have a look. Right, so I've done that one. I've done that one as well. Does salary sacrifice affect the final salary calculation or redundancy payment if you were made redundant whilst making salary sacrifice payments? Not for the pension contribution. So if you're doing salary sacrifice for your AVC, it does not affect anything else. Some employers may have other salary sacrifice things, such as a car. That probably will do. So it depends on the salary sacrifice specifically. But if you're asking me about AVCs, then no, it doesn't. If you don't take the lump sum, is all of your monthly pension payment taxed, earnings above tax threshold, or is 75 a monthly? So the way that these schemes work, and I can see what you're getting at, is that you've got your lump sum option. You either take it or you don't. Where you don't, because your pension is paid to you from these schemes as a regular income, like a salary, it is all assessed for income tax purposes. Okay, that's where it differs again from those defined contribution options. So any pension payment is assessed for income tax purposes. So again, you get your tax thresholds as normal and it will be assessed against that. If you take the lump sum from the AVC, will your pension not reduce unless you take it early, even the first section? So the reductions apply in two circumstances. One, if it's taken early because of the early retirement factors that apply to the relevant section and your age. And two, if you choose to swap your main local government pension for lump sum. If you take a lump sum from the AVC, you are not swapping anything out from your main local government pension, so it doesn't affect that. If you leave work but haven't claimed the pension yet, so it's deferred, do the family still get a lump sum? They do, and it is 5 times the pension, whereas when you're in service, it is 3 times your pay. Is the lump sum death in service benefit taxable? Not currently, no. Not from these schemes at the moment. There is a proposal, because there was a talk about it, that it may be included within inheritance tax allowance, but we still have not seen how that is going to be implemented. So all we can say is at the moment, no. If you were going to be a higher rate taxpayer after retiring, would you generally expect this to tip the balance to taking a larger tax-free lump sum? Probably, yeah. It becomes more of a serious consideration for those people who will be higher rate taxpayers. Again, it's circumstance dependent. So I don't want to get into it too much, but there is a stronger case, isn't there, if you're going to be paying 40% tax on the pension. Don't forget as well, your state pension is also taxable. So they don't usually deduct tax off the state pension itself, but once you get your state pension, it pretty much takes up all of the personal allowance. So that could be something else to think about. How is annual allowance worked out? I realise it's 60k or salary, but I'm finding it difficult to get an exact figure of how much my allowance has been used. And that is because in the local government pension scheme, we don't look at contributions, we look at the growth in the pension. So very briefly, what we do is we look at the annual pension amount at the start of the tax year. So let's say at the 6th of April, my annual pension that I had built up was 10 grand. And then we compare it to what it is at the end of the tax year. So let's say that my pension at the end of the tax year, so the 5th of April, is 12 grand. That tells me my pension has grown by £2,000 a year. I then multiply that by a HMRC factor of around about 16, and that will give you my pension input amount of 32,000. And that is what we use in schemes like the LGPS. Most of the funds do actually put what they call the pension input amount on your annual statement. So hopefully it will tell you on there. Or what you can do is ask your pension fund for a pension savings statement, and that will include the pension input amounts as well. But it's growth in pension times 16. That's what we're looking at. My local authority don't have a modeler and take weeks to answer emails. Is there a minimum service level they should meet? Yes. This isn't West Midlands by any chance, is it? Yes, and again, the service level should be on the website. Usually we would expect it to be 20 working days, so a month, but it might depend on their specifics as well. You can raise complaints, you can speak to your employer. If it's West Midlands are dire at the moment because they've had a new system come in and everything fell apart, but there are others that are also struggling. Can you talk about taking a deferred pension? Certainly, not really a lot to say. A deferred pension is when you've left already, but you haven't put the pension into payment. So it's calculated at the time that you leave. And then when you want to put it into payment, it's the same thing. You have to go onto your pension fund website, you find the relevant form, you fill it in, you say you want to take it. You can take it earlier, as we talked about before. It has the same reductions applied. Nothing is different. You do have to take it all at the same time, though. There we go. It's exactly the same, just that you've already left. I have a model on my portal. It allows me to slide to show maximum lump sum, which reduces the pension. Is this the maximum if selected tax-free? Yes, they will calculate the maximum tax-free, and assuming that is not more than £268,275, it is tax-free. If I take voluntary redundancy age 61, will my pension still be reduced for leaving early? No. So in the local government pension scheme, there is a fabulous rule for redundancy that if somebody is made redundant over the age of 55, your pension is immediately put into payment without any reductions for early payment. How amazing is that? Doesn't exist anywhere else. Pray for redundancy, everyone. Could I take some of my pension under the 85-year rule and do flexible retirement? Yes. You can do flexible retirement. If you only want to take some of it, you have to do a flexible retirement. You haven't got any other option. And presumably frozen at point of leaving, how does the inflationary factor increase? So pensions increase each April in line with the increase in the consumer price index. And they use the consumer price index rate from the previous September. So April 25 was based on September 24 inflation. That applies to your career average pension each year. Then it's growing because it's inflation linked. It applies to deferred pensions. It applies to pensions in payment. Can you explain carry forward? No, not on this session. I can't. Sorry. Carry forward is all around the annual allowance, and that's a whole other separate session where we have to talk about what that is and how it works. So sorry. You might find some information on the main LGPS website. In fact, I'm sure they've got a fact sheet on it, so you can have a look at that if that is helpful. Nottinghamshire. Oh, I didn't know they were that bad. Sorry. My local authority modeler has a minimum lump sum. Is this from the first section only? Yes. So if you remember the first section, what we've said is you have to take a lump sum from that, which is 3 times whatever that first section is, and that will be what the minimum is. Yeah. When you say VE over 55 pays early with no reduction, would this be at the full age 67 pension? Right. So 2 things. Okay. When you leave the scheme, no matter what circumstances, your pension is calculated at that point in time. Okay. If you then want to put it into payment early, say at 55, it would be reduced. So you've got the pension you've built up to the point that you leave, and that is then reduced for early payment. When you've got a voluntary exit or redundancy, you've got the pension that you've built up, but it's paid without the early retirement reduction. They're not giving you future pension for free. They're not doing that. But what they are saying is whatever you have built up, because remember at this point you're leaving the scheme, so it's not going to grow anymore anyway, but you can take it now without the reduction. Does that make sense? Fabulous. Okay, perfect. How hard is it to transfer out of the pension scheme with a CETV at 61? Oh, okay. So local government pension scheme does allow you to transfer out, subject to you receiving appropriate financial advice from a specialist financial advisor who is able to give you advice on defined benefit transfers. And the reason for that is because when you transfer out of a scheme like the LGPS, you are giving up a significantly valuable benefit. And so people need to have made sure they've got the correct advice to do it. So it's okay to do if you get a financial advisor who is qualified to help you with that, and if they say it's a good idea. So that's what you need to do. There are not many of them because the insurance is extremely high for financial advisors in this area. One that I do know of is Grove Pension Solutions. They do that. But it's something you'd have to think really carefully about and get the relevant advice. There are circumstances that it's the right thing to do, but that's what your advisor will help you with. Post 2014, what could be potential benefits of having parts of a pension deferred? So if you mean just, I'm trying to think of a scenario. Do you mean just 2014 benefits, or have you got benefits before that as well? If you've just got 2014 benefits, can you give me more detail around the question? Because there's different, right? Okay, just 2014. Do you mean though you've got post 2014 benefits in one fund and now you've gone into another fund, and what you're trying to work out is, do you put the two together or keep them separate? Sorry for everybody else. Yes, right, okay. So person has, I don't know, let's say 5 years post 2014. That is career average. It is now deferred, and they're now in another fund where they've also got post 2014 for future going onwards. So what person is asking is there any benefit leaving it separate or putting it together? No, I mean either or. Both are linked to inflation. Both would grow at the same rate. If you put it together, it's probably easier to manage later on. It does mean though that it's all lumped together and you have to take it together. If you kept it separate, you would have the option of taking it separately. But because it's career average and there's no link to current pay in that sense, it doesn't really matter in the wider scheme of things. That makes sense? Okay, last one, and then I'm stopping. Okay, I have moved job from one local authority to another in a different area, and I've been taking the decision to merge the pension schemes. I have 18 years to transfer. I've had to wait a long time as they are being merged. Why is this? Have I made the right decision? I don't know. I don't know if you've made the right decision because I know nothing about your circumstances. I don't know your pay. I don't know your age. Don't tell me. I don't know what your objective is. I don't know. If you didn't know or don't know about making that decision, get some help so that you can make sure you've made the right one. So these are my details. Again, you'll get the slides. It might be worth jotting down my email address just in case the slides go into some sort of magical, mystical internet ether. But I'm going to send them to you shortly. The recording will be available on our Pen-gage YouTube channel, probably about around the end of the week. So you can watch that back as well with the recording. We do provide individual support. So we're not regulated financial advisors, we are pensions consultants, which means we can do things like modelling, forecasting, help you understand your options, how to fill forms in, all that kind of stuff. It's a chargeable service. So the reason we put these webinars on for free is to try and give you a hand, but also do encourage you to use the free stuff first if you can. I also know it's quite a lot to take in, so go away and process it, have a look at the slides in your own time, watch the video back as well, and hopefully that will be really helpful to you. Perfect. Oh, you're more than welcome, everyone. Lovely. Okay, wonderful. Right, I'm going to finish it there. Watch out for the slides. Have a really nice evening, everyone, and maybe we will see you on the Facebook group as well. Thanks, everyone.